What if Wall Street is pouring billions toward a technology most people still cannot explain in one sentence? And what if the biggest winners are not the loudest companies, but the three names smart analysts believe could own the future before the public fully catches on? If you like videos that turn confusing market stories into clear signals, you can actually use tap like, subscribe, and share this with one friend who loves finding big trends before they become obvious. For years, quantum computing sounded like one of those ideas that always lived 5 or 10 years away. It was exciting, it was complex, it was easy to ignore. Most people heard the word quantum and checked out. They pictured lab coats, strange physics, and machines from science fiction, not a real investment portfolio. But now something has changed. The tone on Wall Street has changed. The money has changed. The language has changed. Analysts are no longer talking about quantum like a school project with promise. They are starting to talk about it like a high-risk race with real market leaders forming right now. That shift matters, because when Wall Street changes its story, it usually changes its behavior next. And when behavior changes, capital follows. That is how small ideas become major trades and niche sectors become obsessions. And that is exactly why so many investors are suddenly asking the same question. If quantum really is moving from dream to business, which stocks could become the biggest winners? Today, we are breaking down 3 stocks analysts are betting on in this new quantum rush. Not based on fantasy, not based on social media hype, and not based on random message board excitement. We are looking at where the street sees momentum, where the business progress is real, and where the danger still hides under the surface. Because that last part matters just as much. This is not a safe corner of the market. These stocks can rip higher in a week and then give half of it back in a day. Some of these companies still produce tiny amounts of revenue compared with their valuations. Some burn serious cash. Some are trying to build technology that may take years to fully prove itself. So if you're expecting calm, steady, boring businesses, this is not that story. But if you want to understand why serious analysts are still leaning in, even with all that risk, stay with me. Because the real story here is not just about 3 stocks. It is about what Wall Street fears most: missing the next platform shift. That fear has become stronger in 2026, a lot stronger. Artificial intelligence already reminded investors what happens when a technology wave goes from interesting to inescapable. Once that shift happened, the market stopped asking whether compute mattered and started paying almost any price for the companies closest to the center of the storm. Quantum is not at the same stage as AI, not even close, but the market has started to wonder if the same pattern could begin much earlier than people expected. To understand why, we need to make this simple. A normal computer processes information in bits. A bit is either a 0 or a 1. Quantum computers use qubits. A qubit behaves differently, which means certain problems can be approached in a radically different way. That does not mean quantum computers will replace your laptop or phone. That is one of the biggest misunderstandings in this whole space. Quantum is not about making email faster. It is about solving classes of problems that crush classical systems, or at least offer a new path for optimization. This includes simulation, material science, logistics, chemistry, and cryptography. In plain English, if classical computers are great at following long step-by-step instructions, quantum systems may eventually help with certain massive, tangled problems where the number of possibilities explodes too fast. That is why companies, governments, and researchers care so much. Better drugs, better materials, better routing, better machine learning tools, better security, or in some cases, broken security if bad actors get there first. And that is another reason Wall Street is paying attention. Quantum is no longer being framed as a cute science experiment. It is being framed as strategic infrastructure. Governments are spending, defense agencies are signing contracts, universities are buying systems, cloud giants are opening access through their platforms, and investors are starting to see the same thing they saw in other major tech waves. Once the tools reach a certain point, the money rushes in before the public fully understands why. Still, here is the key truth. Not every quantum company will win. In fact, most probably will not. Some will build impressive hardware but fail to create durable businesses. Some will have great science and terrible stock performance. Some will get buried by dilution, delays, or hype. That is why analyst behavior matters here. It does not guarantee success, but it can show you where professionals think the risk-reward looks most attractive right now. And when you look across this space, 3 names keep standing out: IonQ, D-Wave, and Rigetti. Each one represents a different way to bet on quantum. Each one tells a different story about how this market could develop. And each one comes with a very different mix of upside, credibility, and danger. Let's start with the name that many analysts still see as the flagship of the group, IonQ. IonQ is the stock that often gets treated like the face of public quantum investing. There is a reason for that. It has scale, visibility, and a growing list of partnerships. And unlike a lot of speculative tech companies, it has been showing real commercial progress that is getting harder to dismiss. In the first quarter of 2026, IonQ reported record revenue of $64.7 million. That was not just growth, it was a 755% year-over-year surge. The company also raised full-year revenue guidance to between $260 million and $270 million. Just as important, remaining performance obligations climbed to $470 million. That is a big figure because it gives investors a sense of contracted future business still waiting to be recognized as revenue. In a space where people ask, but where is the real demand? That number matters. IonQ also said it had $3.1 billion in cash equivalents, and investments at the end of the quarter. That is a huge war chest for a company in this kind of race. Cash does not make the business safe, but in a sector where time matters and roadmaps can slip, cash buys patience. It also buys hiring, acquisitions, and survival. And IonQ has not been sitting still. The company highlighted the sale of its first 256-qubit system to the University of Cambridge. It also pointed to work with DARPA. This included a $39 million contract tied to tactical space communications. On top of that, management has been pushing a bigger vision that goes beyond pure hardware. Quantum networking, quantum cybersecurity, fault-tolerant architecture. The message is clear. IonQ does not want to be seen as a one-product company. It wants to be seen as a platform company. That matters because platform stories tend to get bigger valuations. Wall Street loves the idea that one winner in a new technical wave can control several layers at once. If IonQ ends up being more than just a machine builder, if it becomes an ecosystem player with software, networking, and government credibility, the bull case gets much stronger. Analysts seem to see that possibility. MarketBeat shows IonQ with a moderate buy consensus from 17 analysts, with 10 buy ratings, 6 holds, and 1 sell. The average 12-month price target there sits at $69.88, with the high target reaching $100. That does not mean the stock has to go there. It means the street still sees a group of professionals willing to model real upside even after the sector has already become crowded and volatile. Now, before anyone gets carried away, the bear case is very real. IonQ still burns cash. Its adjusted EBITDA guidance for 2026 remains deeply negative. This stock has also shown how violently sentiment can swing when expectations get too hot. MarketBeat noted that recent pressure on the shares has come from valuation concerns and profit-taking, not just company-specific bad news. That tells you something important. In sectors like this, the stock can fall hard, even when the business seems to be doing many things right. So why are analysts still betting on it? Because in a market this early, leadership matters more than neat income statements. IonQ looks to many on the street like the company with the clearest mix of momentum, visibility, cash, and credibility. It is not a proven giant, but it may be the cleanest public vehicle for investors who want exposure to trapped ion quantum systems and a broader commercial quantum platform. And there is a deeper emotional reason investors keep coming back to IonQ. It feels like a company trying to become inevitable. Whether it succeeds or not is another question. But the ambition is obvious, and Wall Street often pays for ambition long before it pays for certainty. Now let's move to the second stock, and this one may be the most misunderstood of the three. If this breakdown is helping you separate the story from the stock, hit the like button now, subscribe for more deep dives, and send this video to the one person you know who always asks for the catch. D-Wave is different from IonQ in both style and strategy. While much of the market gets obsessed with universal gate-based quantum computing, D-Wave built its identity around quantum annealing. That may sound technical, but here's the simplest way to think about it. D-Wave has focused on a type of quantum system aimed at solving optimization problems. That means questions like how to route deliveries better, allocate resources faster, or search through complicated decision patterns more efficiently. That difference has always shaped the D-Wave debate. Bulls say the company has something many others do not have yet, clearer commercial use today. Bears say annealing is too narrow and that the biggest long-term value may still belong to universal systems. In other words, D-Wave has often looked like the company closest to practical business use, and at the same time, the company investors worry might be boxed into a smaller lane. But 2026 has made the story more interesting. In its first quarter results, D-Wave reported revenue of $2.9 million. That number alone would not wow anyone. In fact, it was down sharply from the year before. But the important detail was why. The prior year period included a major system sale, so the comparison was distorted. What really caught attention was bookings. D-Wave reported $33.4 million in bookings for the quarter and $42.4 million in remaining performance obligations. It also ended the quarter with $588.4 million in cash and marketable investment securities. Those are the kinds of numbers that change the conversation. Bookings matter because they suggest demand. Remaining performance obligations matter because they hint at work still in the pipeline. Cash matters because it keeps the company alive long enough to chase the next stage. Then comes the strategic twist. D-Wave acquired Quantum Circuits, which gives it a stronger path into gate model quantum computing. That is a big deal. It means the company is not staying locked inside a single identity. It is trying to become a dual platform player. Management laid out a roadmap that points toward increasingly advanced gate model systems over the next several years. This includes long-term goals around logical qubits and quantum utility. That changes the way analysts can frame the story. Instead of saying D-Wave is just the annealing company, they can start saying D-Wave might offer both near-term commercial relevance and a long-term path toward broader quantum capability. That kind of narrative expansion is powerful in the market. Analysts have noticed. MarketBeat shows D-Wave with a moderate buy consensus from 17 analysts. The average 12-month price target is $36.80, with targets ranging from $22 to $45. Barron's also reported that Jefferies and Wedbush both rated D-Wave the equivalent of buy, with price targets of $45 and $35. That is meaningful because it shows support from recognizable Wall Street voices, not just retail excitement. There are also signs that D-Wave's commercial credibility is getting noticed outside the stock market. MarketBeat highlighted recent positive sentiment around D-Wave being named a leader in an IDC MarketScape assessment and receiving grant support tied to U.S. quantum leadership. These details may sound small next to daily stock moves, but in a sector built on trust, every outside validation matters. Still, the risks are obvious. D-Wave's revenue can be lumpy. Losses remain large. The stock is volatile. And the market can turn fast if investors decide bookings are exciting but not enough. There's always the danger that the company gets trapped in the middle, not cheap enough for skeptics and not dominant enough for dreamers. So why are analysts betting on it anyway? Because D-Wave may offer one of the most interesting risk-reward profiles in the space. It has a real installed story around optimization. It has a clear argument for practical customer use in some cases. And now it has a broader technological ambition that could expand its total opportunity. For Wall Street, that is a compelling setup. A company with a real business now, a bigger dream later, and enough cash to keep moving. And emotionally, D-Wave hits a different investor nerve than IonQ. IonQ feels like the polished frontrunner. D-Wave feels like the company that may surprise people by winning through usefulness before glamour. Markets love glamour. But sometimes they reward usefulness first. Now for the third stock. And this one may be the purest, high-risk, high-upside bet of the group. Rigetti is the name that often attracts investors who want torque. Not stability, not safety, torque. The belief that if the company executes even a little better than expected, the stock could move like a rocket. But that same logic works in reverse. If progress slips or enthusiasm cools, the stock can come down hard. Rigetti's appeal starts with its technical approach. The company focuses on superconducting quantum computing and has pushed a chiplet-based architecture. This architecture aims to improve modular scaling. In the first quarter of 2026, Rigetti reported revenue of $4.4 million. That is still tiny compared with its valuation, but it was a big jump from the year before. More important for survival, the company reported $569 million in cash. This includes cash equivalents and available-for-sale investments with no debt. That balance sheet matters. In frontier tech, cash is oxygen. Rigetti also pointed to several technical milestones. The company brought its 108-qubit Cepheus 1 108Q system into general availability. This was across its own platform and major cloud partners, including Amazon Braket and Microsoft Azure Quantum. It reported median 2-qubit gate fidelity of 99.8% on a 9-qubit system with very fast gate speeds. It also shipped a 9-qubit Novera system to the University of Saskatchewan and announced plans to invest up to $100 million in the United Kingdom. This helps develop a system with more than 1,000 qubits over the next few years. For bulls, that sounds like exactly what they want to hear. Technical milestones, cloud access, a modular architecture, a strong cash position. The company's still small enough that any real commercial breakthrough could reprice the stock dramatically. Analysts are interested, but more cautious than with the other two. MarketBeat shows Rigetti with a moderate buy consensus from 12 analysts. This includes 7 buys, 4 holds, and 1 sell. The average 12-month price target is $30.60, with a high of $40 and a low of $18. That range itself tells the story. There's belief, but there's also major disagreement, and that disagreement makes sense. Rigetti reported an operating loss of $26 million in the quarter and a non-GAAP net loss of $14.7 million. Management also acknowledged technical issues that emerged at scale and required design refinements. That is not shocking for an early-stage company. But it is a reminder that the path here is not straight. There's also the memory of dilution hanging over the stock. As U.S. News noted, Rigetti shares had previously dropped after the company raised money through an at-the-market stock offering. That kind of move is common in speculative growth stories. It is also painful for shareholders. In hot sectors, investors can overlook dilution during rallies. When fear returns, they remember it very quickly. So why is Wall Street still betting on Rigetti at all? Because it might be the most levered bet on a hardware breakthrough. If IonQ is the broad platform leader and D-Wave is the practical challenger, Rigetti is the engineering swing. Analysts who like it are not buying clean fundamentals. They're buying the possibility that a smaller player with technical progress could capture huge upside. This happens if the roadmaps start to hit and the market decides its architecture deserves a larger seat at the table. This is where many investors get confused. They think analysts are choosing the best company in a normal business sense. That is not always what is happening in frontier sectors. Sometimes analysts are choosing the most attractive narrative to risk setup at a given moment. Sometimes they are looking for which stock could attract the next wave of capital if one or two key milestones land. That is why all three of these names can attract support at the same time. They are not identical bets. They are three different expressions of the macro theme. Quantum is getting closer to commercial reality, and investors do not want to be absent if the turn becomes real. Let me pause here and say something that could save people a lot of pain. A good technology story does not always make a good stock at the current price. That is one of the hardest lessons in markets. You can be right about the future and still lose money if you pay too much. If you want more market stories explained without the fake hype, subscribe right now and leave a comment with your favorite stock. Share this video with someone who needs a reminder that promising and priced correctly are never the same thing. So what is really driving Wall Street into quantum now? I think there are 5 forces working together. First, the sector finally has better numbers to talk about. Not perfect numbers, better numbers. IonQ's revenue surge and backlog growth gave analysts a stronger commercial case. D-Wave's bookings explosion gave the market evidence that demand is not theoretical. Rigetti's technical milestones and cash position gave bulls a reason to believe the company still has time and resources to matter. The story is still early, but it is no longer empty. Second, quantum has become geopolitical. This is not just about private labs anymore. Governments care about it for national security, encryption, communications, and strategic advantage. When the state starts treating a technology as critical, investors pay attention. They know government interest can become contracts. Subsidies, partnerships, and political support follow. Those things do not guarantee profits, but they change the survival odds. Third, cloud distribution has lowered the imagination gap. Years ago, quantum felt remote because very few people could touch it. Now companies can offer access through platforms investors already understand, like Amazon Bracket and Microsoft Azure Quantum. That matters because the market values accessibility. Once a technology can plug into existing digital ecosystems, people find it easier to believe adoption might grow. Fourth, Wall Street is haunted by what happened with other transformative technologies. Think about how many people dismissed AI before it exploded. Think about how many investors knew the concept mattered, but still missed the trade because they waited too long for certainty. Quantum creates the same psychological pressure. Nobody wants to be the person saying it is too early right before the sector re-rates. And fifth, there's a scarcity problem. Public markets do not offer endless pure-play quantum names. If institutions decide they need exposure, money gets funneled into a small set of tickers that can create explosive moves. Especially when the float is limited, expectations are emotional, and headlines hit in clusters. But this is also why the danger is high. Scarcity can create bubbles just as easily as it creates opportunity. Look closely and you will see the same tension everywhere. Huge promise. Tiny present-day economics, strong narratives, fragile proof, exciting roadmaps, unclear timelines. Analysts know this. They are not blind to the risk. They are making a judgment that the possible upside is large enough to justify leaning in. That does not mean they all agree on how the race ends. Some prefer IonQ because it looks like the most complete story. Strong revenue momentum, deep cash, and big partnerships make IonQ the cleanest answer for a future category leader. Others find D-Wave compelling because it has a practical business case today while expanding its technological ambition for tomorrow. And then there is Rigetti, which appeals to investors who want the smaller, more explosive possibility of a technically credible underdog. Here is the simplest way to think about the three. IonQ is the quality growth story. D-Wave is the commercial traction story. Rigetti is the speculative hardware torque story. And yes, all three can work, but they will not work in the same way. If the market rewards stronger financial visibility, IonQ may hold up best. If customers care about near-term problem solving, D-Wave may surprise. If one big engineering leap resets the conversation around architecture, Rigetti could move the most violently. This is why the sector is hard. People want one clear winner. The market may not give you that yet. It may reward different stories at different times. In technology revolutions, the best stock is not always the best technology. Sometimes it is the one with the best partnerships or balance sheet. Right now, IonQ is closest to being that symbol. D-Wave is pushing to prove it deserves attention. Rigetti is fighting to show it is not weak. Should you rush out and buy these just because analysts like them? No, analyst ratings are signals, not instructions. They can help you understand professional interest, but they cannot remove execution risk, valuation risk, or emotional risk. The emotional risk may be the biggest. These stocks are perfect for creating bad investor behavior because they sound futuristic and move fast. If you are looking at this group, ask better questions. Am I buying the business or am I buying the headline? Am I comfortable with years of uncertainty? Do I understand the technology enough to know why this company might win? Can I handle a 30 or 40% drop without panicking? Am I sizing this like a speculation or pretending it is a safe investment? Even after all the warnings, I understand why Wall Street is leaning in. A breakthrough field is moving from theory toward application. Governments take it seriously. Customers begin testing use cases. Analysts see real data instead of pure hope. That is exactly where quantum seems to be now. Not proven, not mature, not safe, but no longer dismissible. And that shift from dismissible to undeniable is where some of the biggest stock moves in the world begin. So here is the bottom line. Wall Street has gone all in because the cost of being early looks smaller than the cost of being absent if the technology hits escape velocity. Analysts bet on IonQ as the face of the sector, D-Wave for its commercial combination, and Rigetti for frontier engineering upside. But remember this. In markets, the companies people laugh at first can become legends later, and the ones worshipped early can become warnings. The smartest move right now is not blind excitement. It is clear eyes. Learn the business models. Track the cash. Watch the contracts. Respect the volatility. Never confuse a revolutionary idea with a guaranteed investment outcome. The reason this story matters is bigger than tickers. It is about the next fight over computing power itself. When Wall Street fights over the future, money moves before the public realizes it. So the question is not whether quantum is risky. It is. The question is if this is a massive new market or a loud bubble. Maybe the truth is both. If it is, the winners could be life-changing, and the people who understand the difference first may have the biggest edge.